Welcome back, traders, to another episode. In this one, we're going to be talking all about technical indicators. So what actually is a technical indicator? Well, a technical indicator, is a signal used to determine potential future price movement. Now, you can have signals based on both mathematical equations or patterns where they look at things such as price averages and volumes. Now, there tends to be two types of indicators. You get both overlays and also you get oscillators. So overlays use price action as its scale and will overlay onto the chart. Okay, so these tend to be, your moving averages and lines that you'll see on the chart, and it will mimic kind of what the price action's actually showing us at the time. Whereas oscillators will oscillate on its own scale with a minimum and a maximum value, such as the RSI, which we looked at in a previous video, and they tend to be sort of underneath the chart, and they can be sort of momentum based a lot of the time, and show the sort of momentum that you see in the market, but they're not quite overlaid onto the charts, such as things like your moving average. So now I've been talking about the moving average, this is one of the two main indicators that we're going to be looking at in this video. We're going to be focusing on both the moving average, the MA, and also the exponential moving average, so the EMA. So first of all, let's talk about the MA. So the moving average, is basically looking at the average movement between a set period of candles. So say for example, we have a 50 MA on the chart. So a 50 MA, is going to be looking at the average price movement between 50 candles. Now, obviously, whatever time frame you're looking at, that is what's going to be replicated to those 50 candles. So say, for example, we're looking at a 1 hour time frame, it's going to look at the last 50 1-hour candles, and it will find, the average price values, and it will continue to plot them on, looking at the most recent 50 candles. So that is our MA, and it's quite simply just an average based on every single close of the most recent 50 candles, and then that will give us the average over time. So of course we can get the 50 MA, we can get the 20 MA, I think some people use the 9 MA or the 11 MA. So these are just different values that you can use and play around with to give you a general sloping indicator, where it's going to kind of follow price action, and what it will do is it will track the general trends in the market. Now, separate from the MA, we have the EMA. So the exponential moving average is a slightly more confusing equation to actually work out, but what this is doing is it's focusing more on recent price. So the EMA, it tends to react quicker to price, just due to the calculations that are involved. Whereas the MA will be more of a slower indicator, which may not react as fast. So therefore the slope of, or the angle of the indicator, may take longer to react. Whereas the EMA, because it's based on more recent price action, will react slightly quicker. Now, which one's better, the MA or the EMA? Well, it kind of depends what you're looking for, because obviously there's going to be pros and cons to both. Now, obviously the EMA, by reacting quicker, obviously a disadvantage of that is that, say for example, we're in a downwards trend, so we're trending bearish. By focusing on more recent price action, what might happen is the EMA may give you a potential signal, that the bearish trend is over because of maybe a short-term move to the upside. So because prices started moving bullish, the EMA may pick up on that and tell you that the trend has finished and that price may be moving to the upside. The downside of this is that if price then rolls over and continues to move down, you're then going to be out of your trade and maybe even trading long because you're thinking that the EMA is telling you that the trend is finished. Whereas in the same situation trading the MA, because the moving average takes a little bit longer to actually update, what it might do is it means that when it's trading bearish, a smaller move to the upside may not actually register as well on the MA as a move bullish. So because of this, it may actually hold you in a potential bearish trend for longer. So it may actually be better to trade something like the MA when looking at potentially a higher time frame or looking to hold trades for a longer period of time. Now, an advantage of the EMA and the fact that it gives you, faster and more current price signals is the fact that it will be able to get you out of trades a lot earlier when the market has finished trending. So for example, if that bearish trend was moving lower and lower and the EMA suddenly decided to tell you that price has finished this bearish trend and it may be moving to the upside, the EMA is going to tell you this way before the MA. Okay, now in some situations they may be quite similar depending on what time periods you use. However, the EMA will be slightly more up to date, okay, whereas the MA may take a little bit longer to give you that indication that price may be finishing a particular trend. So of course there's obviously pros and cons to the MA and the EMA, okay, and as well as that also depending on which time period you use, whether you use like the 50 EMA or whether you use the 20 or the 9 or the 11, whatever you use, okay, there's always going to be slight variations and everyone will like to kind of trade them all slightly differently, okay, and work them together to try and give you an overall idea of where price may be moving. So now we actually know, okay, the difference between the MA and the EMA, let's have a look on the charts, okay, and look at some different variations of the time periods that we can actually put onto these MAs and EMAs, and look at the types of reactions to price that we see, okay, by using the two of them. So let's have a little look at that now. Okay, so the first thing we're going to be looking at, okay, is the 50 MA. So the 50 moving average, which means that it's a moving average looking at the average price of every 50 candles. Okay, so the most recent 50 candles will then update the line and so on, constantly looking at the most recent 50 candles. Now the 50 MA would be seen as quite a longer term moving average because it's going to take a very long time to really get an idea of where price is moving. Okay, so this wouldn't really be seen as an indicator you would use to potentially get involved in a trade. However, it is a good indicator to use for a potential longer term trade idea. So if we just have a little look through price action, okay, and the ways in which it reacts to this 50 MA, what you'll see, okay, is general areas of price where you can see it's trading, okay, underneath when it breaks down, okay, you'll see that it trades above here, holding, it breaks down slightly, breaks above, breaks back down again, okay. So sometimes what you'll see, okay, is price will whip both sides. So you'll see that price breaks down, and then it'll break above, and then it'll break back down, and then it'll break back up, and then it'll break back down again, and then it will hold, break above, and then it will hold again and trend all the way down. Okay, then you'll see that price trends up in this area in here, briefly breaks down, and then again breaks back to the upside. So it does show us trends in the market. Okay, sometimes you'll see that price will break above our moving average and then it will hold that moving average and continue to move in a particular direction. Okay, so while this market is trending, what it will do is it will hold you in and it will show that price will continue to be either bullish or price will be bearish, okay, as long as price is holding an MA. Now this is why the higher MAs are good, because they take more time to actually adapt and change because it's looking at a larger sample size of candles. Now if we look at this and compare it to something like the 20 MA or even the 9 MA, what you'll see, okay, is that the lower we go down, okay, the more accurate this line will become, okay, and the faster it will react to the movements in price. Now this doesn't always mean that it's going to be more accurate, however it's going to react faster to price movement. So what you'll see is that the line will kind of magnetize closer to actual price action because it's looking at a much lower time period of candles. However, another thing that we could actually do is look at something like the 50 MA, okay, and then we could also use potentially an EMA with the MA, okay, and use them together to give us a kind of like a secondary confirmation that price may be moving in a given direction. So say for example we had the 50 MA on the screen, so this would be an indication of a longer term movement in price. And then, say for example, we use something like the 20 EMA or even the 9 EMA and use this as a secondary confirmation to maybe actually act as even a buy signal or a sell signal, okay, by using this, because obviously we understand that the EMA reacts a little bit faster to price action. This may give us a slightly better indication, okay, for entries and exits if we pair it with something a little bit more solid, such as a longer term 50 MA. So we're also going to look at that and the ways in which both the moving average and the exponential moving average can actually work together to give us potential confluences for trade ideas. So now we're going to have a little look at the 20 moving average and the 9 moving average, okay, and the way in which the line, okay, changes dependent on the time period. So let's have a little look at that now.
The best time to take action is now. What are you waiting for? Tired of struggling with market direction? Want buy and sell indications at a click of a button? Who wouldn't? Check out TradeDork's buy and sell indicator today at TradeDork.com.
Okay, so now we've got a 20 moving average on the screen. You can now see that the lines have magnetized themselves closer to actual price action. Okay, so the lower we go down, the closer we're going to see price, okay, and this line come together. Now, this can be both good and bad because, of course, the closer we get to the line, you may see that there's going to be even more whips both above and below the line, okay, whereas if it was further away, you would tend to see more of a trending market, which is holding either one side or the other. Okay, so this is obviously the positives and the negatives to reducing your value, okay, in the time period. However, by using a lower time period, we can actually try and treat this as more of an entry idea, okay, or more of an exit idea, because it's going to be a little bit quicker, okay, and it's going to react a little bit faster. So, of course, if we look at the market now, we know that price and the line, okay, have come closer together. Obviously, you're still going to get areas like this where price trends to the downside. But of course, okay, you're going to see lots of areas, okay, for example, where price is going above and below, and then above and below and above and below. Okay, this line's going to become quite flat because, of course, it's replicating price on only a 20 candle basis. Okay, so it's looking at the last 20 candles and it's giving you an average price point. Okay, so it's going to replicate price to some degree. Okay, so again, price is pushing up and it's going to show you those moves to the upside. Now, of course, indicators can be quite laggy in some respects, okay, and you're not always going to be able to catch these moves straight from the beginning. Sometimes you're going to have to wait for the first kind of impulse in price for the line to really give you an indication that it's moving bullish, and then we're going to have to look to get involved in those potential areas of break and retest to actually trade a particular trend in a given direction. So now we've had a little look at the 20, okay, and we've compared this to the 50 line. Let's have a look at the 9 now, okay, which is the final line we're going to be looking at, and we're going to just compare this to the 20 line. So let's put that on now, okay, and let's look at the difference between this line when we're trading 20 candle period and a 9 candle period. And there we go. So now you can see, okay, price again has magnetized even closer, and now the line is almost completely replicating what price action is doing, okay. It's become a lot more in touch with what the market's currently doing. Okay, if the market's pushing down, this line will come down. It's predicting every kind of move up, back down again. Okay, every time the market moves up, it will follow. And it will always be doing this because now it's only looking at every 9 candles before it plots on the next point on the line. Okay, so because of that, now, okay, it's really not that good to want it to be able to trade this on a longer term period because it's constantly going to be telling you to go above the line and then below the line, above the line, below the line, above the line, and then below the line. So it's not very good for a longer term move in the potential bearish direction, for example, where we can see that market is clearly moving down. However, based only on this line, what we're seeing is moves down and up, down and up. So what we would really want is to be able to trade a smoother line, okay, which may, for example, hold us in, okay, more of a bearish longer term move. Then that is where something like the 50 MA is going to come in handy compared to, say, the 9 MA. So now what we're going to do, okay, is put back on the charts the 50 MA, and what I'm going to do is add on an EMA and look at the way that the two lines work together, okay, to give you potential areas of bullish trends and bearish trends. So let's have a look at that now. Okay, so now on the charts, what I've done is I've added both a 50 MA and also a 9 EMA. So the 9 EMA, okay, is represented by this blue line in the background, and the 50 MA is represented by the green line. Now already we can see the difference between both the 50 MA and the 9 EMA. The fact that the 50 MA, okay, you can see isn't reacting as much to price. It's more of a smooth line, okay, it's kind of showing the trends a little better, okay, and it kind of gives you a general idea of where price is moving. However, the blue line, okay, which is our 9 EMA, is clearly, okay, much more responsive. It's pushing up, pulling back, pulling up, down, up, down, up, down, up, down, up, down, up, down, up, down. Okay, it's constantly just moving backwards and forwards, okay, because it's following price on a much more accurate basis. Now, obviously, like we've said, there's pros and cons to both the 9 and the 50, depending on how you use them. However, what if you use them both together? So say, for example, you use the fact that whenever the 9 EMA crosses over the 50 MA, okay, this could be more of an indication of price moving in that direction. And then, what if you were to hold that trade, okay, or potentially use that bias until the 9 EMA crossed back over the 50 MA? Now let's have a little look at that principle, okay, and look at it in action. So if we start over here, okay, and we say to ourselves, well, if price breaks above, okay, the green line, so the blue line crosses over the green line, okay, that is going to be indication to trade long. Okay, now as you see, price pushes up, okay, and this blue line will hold all the way up here, okay, and it will give us a chance to move pretty much from this area to this area, okay, and it will hold us in the market, even though the EMA, okay, is moving up and down, and price action, okay, is clearly moving above and below, okay, this line. But we're not looking at how price action responds to the trend line. What we're looking at is how one indicator, okay, responds to another indicator. So then what do we see? Okay, the 9 EMA crosses back over here, okay, and now it begins the downtrend. So at this point, okay, you can see that the downtrend starts. Obviously in the overlay we have actual price action and, you know, the entries and things like that. We can also look at obviously our support and our resistance, our break and retest, our candlestick structures, all these different things that we've got in our arsenal, okay. At the moment we're solely trying to figure out the trend. So here you can see the EMA crosses over, okay, and then it holds here, it holds down, it crosses over very briefly here, but that might not even be enough, okay. You then immediately see it cut back down, and then we then continue this trend to the downside, okay. So overall, this blue line is clearly holding below the overall green line, okay. And then again, okay, it goes all the way down until eventually this area in here where price swaps over. So again, you were able to predict moves from this area all the way down to this area, okay, just by using the simple concept of the 9 EMA crossing over the 50 EMA. In this area in here, okay, yes, we do get a brief area where the EMA crosses back over, so it is giving us potential bullish intent, which is absolutely fine, okay. But if you look at the actual MA, so the green line, when price crosses over here, okay, what is the angle of the MA? And if you look at the actual angle of this MA, the MA is still clearly pointing down, okay. Now there's no indication on this MA that price is even attempting, okay, to start a move to the upside, okay, because obviously it's looking at the most recent 50 candles. So as far as the MA is aware, okay, it's looking at the most recent 50 candles in this area, and it's saying that price averagely is still pointing down, okay, it's still showing bearish intent. So that could actually be an additional factor that you could actually use in your advantage, okay, and you could say, well, even if price does break above my 50 MA, I actually want to wait for the MA to actually point upwards to give me an actual reason, okay, that price may be changing from a bearish to a bullish trend. So as you can see, yes, we do cross over, but of course we're still actually holding these structural points in here, okay, and you can see that we're just getting some kind of reaction to the resistance which was created up in this area in here, okay. So on a structural basis, we're still seeing that price is clearly down, okay. Yes, the blue has crossed over the green, but the green's still down. So again, you know, we could still be looking for trades in areas in here. Already I've just noticed that we've got this evening star formation in this area such as this, okay. So like always, you know, this EMA crossing over the MA doesn't have to be a confluence that you use if you've got other additional confluences for your trade, okay, but it is an important one that you can use if you use it in the right way. So now, okay, the green line's still pointing down, absolutely fine. Eventually the blue crosses back over the green, okay, and then we can continue our trend to the downside. So again, what happens, okay, price again pulls down, okay, it holds the green, we break lower, even though price is breaking above the green level, okay, it doesn't matter because the blue line is holding it. The blue line's holding, okay, in this area in here we're very, very sideways. Okay, now this is the first area where the green line actually starts to pull upwards, ever so slightly. Okay, it isn't really a vertical upwards, it's more of a kind of a flat slope. However, there is a slight incline here, so this could be an area where you feel as though your trend may be finished. You would be seeing this, okay, as clear, corrective, consolidating price action, the way that we have lots of small bodies, lots of big wicks. Okay, lots of things like this are all indications that price is actually, in that kind of ranging market. So when this happens, okay, you might not even see any clear trades or any clear signals to trade long, and you may be waiting for more confirmation. However, then what happens? Price then breaks back below, and immediately we start another impulsive move. So of course, if you were identifying that this is your impulsive phase and this is your corrective phase, okay, suddenly you're going to be looking for continuation structural patterns. You may see some kind of 3-touch channel, okay, in areas such as this. Okay, and that might have given you some kind of indication, okay, that price is going to be continuing down. As well as that, okay, if you don't think that's quite an ascending channel, what we do have is some kind of expanding. So as you see, okay, if we put on the price points, what have we got? And we've got that kind of expanding nature, okay, and that's showing us, again, more continuation candlestick structures. So it makes sense that price is consolidating here, and there's no way that I would want to look to take this long, because I can clearly identify what phase of the market we're in, okay, and it's showing us that we're still probably going to be moving bearish. So after that, price again impulses to the downside, and this blue line holds all the way. Okay, again in here the blue line crosses over only briefly, but again our green is heavily down. Okay, there's no real signs like this that we're putting to the upside. Okay, straight away the blue line realigns, and then eventually the blue line crosses over, and now we actually get the fact that the green line is starting to curve to the upside. Okay, so now we would start looking for impulses and corrections to take trades bullish. So then, the blue line clearly holds price all the way up here, okay, brilliant, all the way up here. Again, the line crosses over here, and it takes, a long time for this green line to even show potential signs that we're moving to the downside. Okay, it tends to go very, very flat before we then again push up, okay, and then again in here, obviously now we've actually created some kind of reversal. We've created this large impulsive leg in here, and after this, and we've got the fact that we've crossed over the green, you can then see the green starts to trend back bearish. Okay, we then get a couple of different changes in here where we see price break above and then price break back below, and then again we're in another long trend. So you can see how by using a lower time frame EMA, okay, which is much more responsive to price action, and you're using it with a longer term 50 MA, okay, which takes much longer to actually react, what you can do, okay, is use them together to actually be able to trade the longer term trend, but be able to get in and out of the market with the shorter term EMA. And this is the best way to be able to trade it, okay, because we're seeing, clear trends from areas such as this all the way down, okay, and it's given us, massive movements in price where the trend will remain the same, okay. Price then holds up, okay, and we get this whole leg again from this area pretty much to like these highs, okay, all the way up. It's holding, okay. In here it's a little bit changing around, we've got a little bit of a down leg, breaks back up, holds pretty much, okay, and then we start to trend back down again. So obviously in some areas, you may get caught out. Obviously you want to have additional confluences, you want to make sure your structural things are all aligning, etc. Okay, but it's a great way to be able to get even into scale-ins, okay, where you get into additional positions if the trend is showing you, okay, something very important with all these additional confluences, like having the MA and the EMA all aligned. Now this is a very interesting area of price action, because before, when we just looked at a lower period MA, okay, we saw this area as very corrective, okay, and price was very choppy and it was moving back and forwards over our line. But now look, okay, at what both the EMA and the MA are doing. The EMA, if you look carefully, okay, actually holds the green line. So even though we're consolidating throughout this whole period, it never once breaks the green line. So it allows you to trade, okay, and necessarily not get caught out in situations like this where price is very consolidating, okay, and what it will do is it will make you hold your long trades. Because, okay, nothing has told us that price wants to move back bearish, okay, the blue line's holding the green line, and then it gives you this beautiful trade to the upside, okay. So here you can see the blue line holds all the way, okay, the blue line literally holds all the way up to the top. An absolutely beautiful run, okay, and it's still holding, okay, and we're only just coming back to the MA right now. So that's a clear example, okay, of a beautiful trend and the way in which the lower period EMAs work very well with a higher period MA. Now we're going to talk about Bollinger Bands, okay, how they're a slightly different version of these kind of moving averages, okay, and how they kind of look at a overall picture where you have a complete price level from a maximum to a minimum, okay, using a 2 standard deviation. And what this will do, okay, is give you kind of areas of potential reversal and areas of potential overbought and oversold price by looking at a more general kind of trending market. So let's have a little look into that now. Okay, so now we can see on the chart I've updated it, and now I've put on the Bollinger Bands. Now, Bollinger Bands are used to generate oversold and overbought price lines plotted as 2 standard deviations away from the SMA. Now the SMA, or the MA, okay, is identified as this green line in the middle, okay, and the trend line both at the top and the bottom, okay, are showing 2 standard deviations away from this moving average. Okay, now what it's trying to show is that price should always remain within either the top line and the bottom line, and what it will do is it will act as a tool to show us areas of overbought and oversold price. Okay, so now we actually understand what Bollinger Bands actually do and the way in which they work. Let's look at the types of reactions that we actually see to these extremes of the highs and the lows. So if we have a little look back through price, okay, what can we actually see? And again, all the time, every time that price reaches one of these top or bottom lines, you will see some kind of reaction. Okay, now not obviously every time, but the majority of the times, okay, if I start highlighting areas such as this, we see a move down. Areas such as this, we see a move back up. It's tapping the top line, we see a move down. It taps the bottom line, we see a move back up again. Okay, and it will just constantly react, okay, to the top and the bottom of the line. Okay, now sometimes like in areas such as this, for example, okay, you can see that price does kind of just trickle down. Okay, you can see that the lines actually get quite close together at this area, okay, which is showing a clear consolidation in price. Okay, but again, once price starts to expand again, then you see these extreme values in areas such as this, and in here it moves away, taps in, and again you can see that the 2 lines, top and bottom, start to squeeze again when we see more of a consolidation in price. So it's a great way to be able to indicate areas of oversold and overbought price, and of course we can use it as a confluence to potentially get involved in different trending trade ideas, because if, for example, we're looking for a trend to reverse, we don't want to be on, for say, the 1 hour time frame, okay, looking for potential continuation trades if we're seeing that price is in an area of potentially overbought price action. Because if it's in an area of overbought price action and we're then looking for a break and retest to potentially trade it long, it's highly likely that that area isn't going to hold, and instead what you're going to see is a potential move back to at least the MA, okay, and then maybe even a move to the lower half, okay. So this is a great tool to show, again, overbought and oversold price action. Of course, you don't have to use all these indicators, but again, it's a good idea to be able to understand how they actually work, and then it's up to you if you want to actually go ahead and use either the MA or the EMA, or even have a little look at these Bollinger Bands and tie that in with our concepts of support and resistance, okay, breaks and retests, and everything else that we've been slowly learning together. So now you have a solid understanding, okay, of how technical indicators work in the market. Feel free to go away and try these out for yourself, okay? Play around with the settings, okay? I've given you some ideas of 50, 20, 9, 11. These kind of numbers, okay, are all tend to be numbers that both respond best to these MAs and these EMAs. And then also have a little look at the Bollinger Bands. Okay, have a little look for areas overbought and oversold price action, see if you get on with it. Okay, it's not for everybody, but it might help you out, okay, when you're trying to add biases to your potential trade ideas, okay, when you're looking in certain directions. Make sure, of course, you don't put too many things on the chart, because you don't want it to be too cluttered, okay? You want it to be, you know, clear and concise, with, you know, correct confirmation, and making sure that, you know, you do have those levels of confirmation and confluence for your trades, okay, without it being too messy and too complicated. So go away and try this out for yourselves, okay, and I will see you all in the next episode. So keep on watching, because we're going to be getting into news events, so you don't want to miss this episode, because it's going to be interesting to learn all about how the news events can impact the markets. So I'll see you guys all there.
Be a dork.